Good morning from our global headquarters in New York. I'm Manus Cranny alongside Danny Berger. You're welcome to Bloomberg Brief. Let's set that agenda. 3 days of a bond market sell-off. Now the most bullish equity calls for 2025 face a new challenge. From Greenland to Mexico, President-elect Trump continues his relentless push for America First policy. And it's tech's big moment with CES in full swing, while Meta shifts strategy to a more friendly one to the incoming president. Good morning, Manus.
Danny, good morning. I want one of those chains, but we'll talk about the jewelry.
Look great on you.
From Mark Zuckerberg a little bit later on in the show. We've managed to turn it around. I mean, risk was interrupted yesterday. That is undeniable. Nasdaq was down 1.8%. It closed itself back. Nvidia is now up 1.79%. But it was the rates market was the tail that wagged the global dog. You're right, Danny. The glide path to 6,700, 7,100 on these markets is now definitely interrupted. And we will go through a period of where is good news on the services side, bad news for the rates market. Roll it over. Ground zero for risk interruption. Strong data, an auction, which they had to cheapen up slightly. The $39 billion worth of 10-year paper had the highest yield at the auction since 2007. I don't want to go back to 2007. Bond yields dropped by a pip this morning. We wait for the 30-year bond auction. That better not be a shambles today. And dark matter, term premium, Danny. It's at the highest level since 2015. Dark matter, eh?
Wow, it's getting ominous this morning. Why don't we look at some stocks we're keeping our eyes on? Maybe something a little bit more joyful. Exxon. We're looking at Exxon this morning. Those shares are slightly higher, 1/3%. It's predicted a $700 million hit to its profit from lower oil prices.
Apple shares are moving as Indonesia has upheld its ban on the iPhone 16 due to the company's failure to meet local investment requirements.
And just wrapping things up with NVIDIA, a big decline yesterday. It is rebounding in the pre-market. Jensen Huang's product presentation, the kind of narrative from that was it left investors wanting more.
And in just a few moments, we'll put the bond market proposition to HSBC, Stephen Major. And a little bit later in the hour, we have Janasiewicz of Natixis joining us.
And just to recap where you left off on the bond market, Manus, because it's been a global sell-off. 10's the highest since April 2024. 30's the highest since November 2023. For JGBs on the 30-year yield, highest since 2010. For the UK, 30-year yields highest since 1998. Joining us now, I'm pleased to say, is Stephen Major, Global Head of Fixed Income Research at HSBC. Stephen, back in November, your call for the bond market for 2025 was 3.5% for the 10-year yield. Since then, yields have moved the other way, higher by 40 basis points. This bond market has had a rethink. Have you had a rethink for the path for 2025?
Well, if you'd asked me what was happening in September when we hit 3.6, then 3.5 wouldn't have been so silly. So the fact is, Danny, in the space of a few months, we've had 100 basis points or so added on to 10-year yields. And I think the best explanation of that is a reappraisal of the Fed expectations. So we've gone from, say, 7 possible rate cuts 1 year forward to 2 or 3, whatever the number is. So that explains the shift in yields. Now, the interesting thing is that people are talking up the term premium. You said dark matter. I called it dark arts. I sometimes wonder whether, in fact, I wonder whether term premium was invented, the whole subject was invented by analysts to try and bamboozle their clients. Because, frankly, the explanation for the yield, Manus and Danny, is in the shift in rate expectations, not in the term premium. The term premium models that everyone will look at on the Bloomberg, the ACM, for example, is a model based on a regression that lags the actual move in the market. So I don't think there's much informational value in that. I think it's gone up, but it reflects where the market's already moved. And so, really, the explanation for the yield shift is in the change in rate expectations. That's a very different proposition.
You've just wounded an entire group of people on the Federal Reserve, but I leave it for you to wound and insult them. I just enjoy the sport from the side. Stephen, good morning. You make it very clear the spike in yields is to do with rate expectations, not this narrative that we've been talking about, which is inflation. I mean, there's been a wholesale ransacking of the very long end of these curves. And everybody says to us, that's to do with inflation not being tamed and potentially resurging. You're nodding, you're disagreeing, you're nodding with me. Okay, you take it away.
I think there's a lot of polar opposites around. So it's the real yield that went up, not the inflation expectation, right? So look at the forward real yield compared to the inflation expectation. You're granted, Manus, I think it was the ISM expectations survey, which showed a spike recently, but that's a survey. I think the reality is the market has anchored those inflation expectations. The shift in the yield is on Fed expectations and in the real yield. When we're talking real yield, I suppose we're talking about real activity, GDP data, maybe fiscal policy, that kind of thing. But not, the inflation expectations, if they are there, the market is confident that the Fed will respond to dampen those expectations. So I think that there's this narrative out there that wants to be bearish bonds, but frankly, can you show me a bond bull? Because I can't see any around here. There aren't any in this place.
Apart from yourself.
And well, I don't know. You maybe, but I'm not meeting many, Manus, in terms of our clients, and that probably tells you something. That has some informational value. Everyone seems to be the same way. They're talking up term premium, talking up inflation risk. Frankly, a lot of it's in the price. Look at the divergence between the US and the rest of the world. Look at the real yield shift. It just seems to me that something has to give. And it's quite interesting that the equities are not living up to the expectations that many people had set for them at the start of the year. At some stage, that's going to feed into a more positive narrative on bonds if it continues.
Stephen, can I give you one more piece of the equation that the bears seem to say, and you can tell me why it's wrong? One of the theories goes like this, that as we know, Yellen's Treasury had been issuing a lot at the shorter end. There was a lot of criticism about that, whether rightly or wrongly. But Scott Besson has come in and said, OK, we're going to shift back to more longer-term issuance. And I know, Stephen, you have said so many times, which I think is so great, bonds are not potatoes. Supply and demand dynamics are different. But investors are front-running this idea that we will have more supply, and specifically that supply will be at the longer end. Hence, you have yields ramping up. Do you think there's any truth to that? And if there is, any sustainability to that move?
No, Danny, thank you. It's an interesting area to explore. So I think we said already that the yield shift is covered and explained by the shift in rate expectations, and it's not the term premium. I think that's the key point. Now, on the issuance, I think it's easy for us all to poke from the sides and say, look, they should have done this. Looking back to the pandemic years when rates were close to zero, then they should have issued lots of long bonds then, shouldn't they? But they didn't. Other parts of the world, they did. Corporates did. Everyone termed out. So the US has put itself in a bit of a pickle there because they've got 25% of the free float in bills, and that's on the high end of their range. So they probably do have to start terming out at some point. Now, the thing is that it wouldn't be a good deal for the taxpayer to be terming out at 5%. When they could roll at 4 to 4.5. So I think that there's a healthy tension here. We don't know where rates are going to be for sure, but I think it's an interesting incentive for the US authorities, and by authorities I mean Fed plus Treasury, to get rates down. Now, that may not be what people want to talk about because everyone's so conventional talking about inflation expectations and the inflation target and the Fed's mandate. But hang on a second, doesn't everyone know that they can't afford to keep refinancing at these rates? So to me, there is a sort of undercurrent, a subliminal message here. They need to get the policy rates down towards whatever neutral is, and the Fed guides a 3% longer run neutral at the moment. And they need to get there because they can't afford to be refinancing at 5. I mean, isn't that the reality? So it's a nice idea to term out, but I don't think they want to be doing that right now. It's not going to be a good deal for the taxpayer.
So you would look. Obviously, it's not, and the interest payments that they've got to make here in the United States of America is a huge portion and an issue for the deficit. Stephen, how can they justify lowering rates in 2025? What is the sequence of data that they need to restart the cuts?
Yeah, so I think that they've actually moved to a more cautious footing because they don't know what the policies are. And frankly, there's a great deal of uncertainty around what the future policy is going to be. So that they're waiting to see what happens. And maybe we'll have a clearer picture in the next 2 to 3 months. Now, the focus on the cyclical data says that they just need to wait, be cautious, but given time, I think that the reality is inflation is not a problem. I don't think it's going to be spiking. The inflation expectations are under control, and gradually, slowly, I think you're going to get more of a cooling of the labour market. There's a very narrow path, but they're trying to thread their way through this path towards the soft landing. The Fed is guiding to 3% for the longer run equilibrium. That says that the current policy is restrictive. So they still want to cut. But I think they're conservative. They don't want to be cutting when the economy is so strong and policy uncertainty is so great. So they're just biding their time. But I think the next move in rates is down, not up. And we have to wait for a couple more months. If you want the crux of this, Manus, is that bond investors are going to get good opportunities to buy through the first half of the year, and ultimately I think the yields will be back where they were a few months ago, which is 3.5 by the end of the year. But it's not going to happen all at once, and it wouldn't be a surprise if we're in a bit of a range for the next few months, and then the yields start to come down when we've got a bit more policy certainty.
Okay, so your call 3.5%. That's unchanged for the end of the year, Steve. In that range, do we get much higher from here in these sort of freakouts? I mean, what is that range that you're looking at?
So look, the forecast is an expected value. And what an expected value is an aggregation of all the plausible scenarios. So with a hard landing, yields could go to 2%. Now, that's not our baseline. Our baseline reflects a Fed that wants to get to a longer run equilibrium of 3% with a soft landing. Now, if the policy rate is unchanged for all of this year and most of next, but is coming down in 2027, if that was the scenario, then it's still difficult for yields to go above 5 on an expected value. And this is the point, is that the forecast shouldn't be a single path. The forecast should be a weighted average of the various plausible scenarios. And frankly, if bond yields are 4.6, they seem to be reflecting unchanged policy for this year and much of next. And that's why I think it's very unlikely you're going to get the 10s trading above 5%. And I think most investors are going to figure that out soon, that you're entering the buy zone. Other people have called it the danger zone. To be consistent, something has to be consistent here. If the bond yield is dangerous for other asset classes, presumably it's also a buy zone for bonds.
You're on absolutely fine form this morning. You know, where others fear to tread, you step in and you want to buy. And we've got your floor. We've got your cap and your floor for 2025, which is 3.5 bid, 5 offered.
I love it. I feel like in one fell swoop, Stephen basically said to the entire sell side community, stop it with just the one call. Give us a scenario analysis. Stephen, I love it. That's great.
Steve, thank you very much. We'll see you very soon. We've got the cap on the floor. Well done, sir. Setting the agenda for 2025 on Bloomberg. Stephen Major there from HSBC. He'll be in town in a couple of weeks. Coming up, President-elect Trump makes some bold statements on foreign policy. More on the story next on Bloomberg.
We're going to be changing the name of the Gulf of Mexico to the Gulf of America. We need Greenland for national security purposes. People really don't even know if Denmark has any legal right to it. But if they do, they should give it up.
Can you assure the world that as you try to get control of these areas, you are not going to use military or economic coercion?
You're talking about Panama and Greenland. No, I can't assure you. I think NATO should have 5%. Yeah, if you're going to have a country and a regular military, you're at 4%. I think they should be, you know, they're in dangerous territory. I think it should be, they can all afford it, but they should be at 5%, not 2%.
That was President-elect Donald Trump speaking at Mar-a-Lago yesterday about his plans for when he re-enters the White House in less than 2 weeks. Joining us tonight to unpack what was a 70-minute presser is Bloomberg's EMEA News Director, Rosalind Matheson. Ros, let's start off with the potential. I mean, this is the art of ambiguity, isn't it? It's the perfect example of ambiguity by President-elect. But it's the threat of military force on Panama and Greenland. You're actually talking about the potential for using military force on a NATO ally. So Is there any belief in the actuality of that, or does it say more about America First foreign policy 2025?
Well, it says more really about Donald Trump's foreign policies as he comes into office again and his negotiating tactics. I mean, he was just refusing to rule out the use of military force or economic coercion was the question he was asked. And it's very unlikely to go to war over Greenland or even over the Panama Canal. But what he's doing is displaying his tactics, which is to make these very expansive comments, potentially threats, quite extreme sounding. And that then forces or encourages other countries to offer him concessions, to give him something to show that he can claim victory. So it's really about the negotiating tactics that he's likely to deploy once he's in office, led about, the reality of him trying to do something like engage in military action over Greenland. It's very, very unlikely that's going to happen. It's just his way of extracting concessions from countries, including Denmark, when it comes to a country like Greenland.
Roz, see, this I find interesting, because we could very well, like many of us did in the first Trump term, just end up chasing our tails and trying to figure out what is truth and what is just a negotiating tactic. What feels different this time, though, is the response of people listening to Trump and saying things. Denmark, for example, last time around when Trump talked about Greenland, said, is this an April Fool's joke? Called it absurd. This time around, the Danish prime minister did say, look, we will keep Greenland. It's not for sale. But then went on to say it's in our interest that the U.S. is involved in our nation and not Russia, that the U.S. is the one that has the stronger presence. Is this a different Europe this time, a different reaction from all over the world and how to handle Trump and really appease him?
Well, having seen Trump in the first term, it probably is. It's about the idea maybe of taking him seriously, but not literally. So he's not going to invade Denmark again over Greenland or try and claim Greenland militarily, but he will be relentless. We can see that. He will keep coming, and maybe he will use tariffs and other economic penalties as a political lever. He's shown his willingness at least to do that. So to get ahead of it, what you need to do in a way is give him something or allow him something that he can claim as a win without ceding too much of your own ground yourself, because you've got your domestic imperatives to think of. So it's that balancing act of allowing him to have something to claim as the victory while not giving him everything that he's asking for. And that's certainly the lesson it seems that countries around the world, be they adversaries or allies alike, are learning.
Roz, thank you so much for joining us this morning. That is Bloomberg EMEA's news director, Roz Matheson. And we do have 2 weeks. Again, all of this is happening 2 weeks until the president-elect takes office. Economies around the world are preparing for this recalibration of global trade and geopolitics. Here's what the European Commission vice president told Bloomberg about the EU's plans.
We will have a plan to protect the steel sector from global overcapacity while ensuring competitiveness. I'm prepared to explore both defensive and offensive actions with my colleagues at the Commission. This is a dialogue that we will have at the Commission. I still hope to convince the next U.S. administration that we have everything to lose from a collective trade war.
Joining us now is Oliver Crook, who spoke with the commissioner there. Oliver, Europe has had some time to prepare for Trump, but this time is different. They have a weaker economy. They're still dealing with the war. They're dealing with the energy impacts of that. This time around, how is Europe getting prepared for 2 weeks away when Trump takes office and policy starts to come down the pike?
Yeah, I mean, listen, Danny, I think a lot of people are very reticent to give exact sort of ways in which they are preparing, because everyone is sort of putting on a brave face and say, oh, let's see what Trump will do. Oh, these are all negotiating tactics. I'm not sure that that is the sort of safest or the most prudent way to sort of approach this incoming presidency, right? And there are ways in which Europe is actually uniquely poorly positioned, particularly on the issue of tariffs, right? On the one hand, Trump wants to right the sort of goods trade imbalance. Europe exports a lot more to the United States than the United States does to Europe. That is something that Trump says he very specifically wants to target. So there's obviously the question of trade barriers going up between Europe and the United States at a time when the European economy is incredibly weak. But Europe also gets the bad end of the other side of this sort of trade dispute between China and the United States. Think about it. If the trade barriers go up between China and the United States, all that overcapacity comes flowing straight into Europe. That kills the industry here as well.
Ollie, thank you very much. Oliver Crook on Europe's growing response to what is the next Trump presidency. I want to show you just some live pictures. This is obviously in the Palisades, on the Pacific Palisades neighborhood in Southern California. 30,000 residents have had to evacuate. These are live pictures of a devastating loss across California as these wildfires burn out of control. Let's get you up to speed with the front pages from around the world. This is what's making headlines. We just showed you some images there, but the New York Times leads with the devastating wildfires in Los Angeles. Parts of Santa Monica and Pasadena have been evacuated as the flames destroy homes along the coast. Over 220,000 are without power due to safety power cuts and wildfires.
Yeah, live pictures there of Malibu. Our thoughts go out to everyone dealing with that. Now, next up on Forbes, Ann Altman, the sister of OpenAI CEO Sam Altman, has filed a federal lawsuit accusing him of sexually abusing him her for several years. She alleged that the abuse happened from 1997 to 2006. The billionaire tech CEO and his family said the claims were untrue and that Ann faces mental health challenges. Okay, coming up, we're going to have more on economic data coming out this morning. We'll catch up with Natixis. From our global headquarters in New York, welcome to Bloomberg Brief. Danny Berger and Manus Cranny here. Let's set your agenda.
3 days of a bond market sell-off. Now the most bullish of equity calls for 2025 face a new challenge. From Greenland to Mexico, President-elect Trump continues his relentless push for American first foreign policy. And it's tech's big moment with CES in full swing and Meta shifting to strategy more friendly to the incoming president, to say the least. I want that chain.
Manus, Christmas is gone and past, and I didn't get you the chain. I'm sorry, it is too late. We'll have to wait for your birthday now. Well, here's a present for you. I'm going to steal some of your language, Manus, because I think it was right that this bond market was ground zero for the turmoil we saw yesterday. The sell-off takes a pause this morning, just below 4.7% on your 10-year yield. That is the highest in 9 months. Strong ISM jolts inflation break-evens and the dollar rose. It is a market pricing in a hot economy, but that good news was bad news for the equity market, which fell more than 1% yesterday. Again, we take a breather this morning. NASDAQ futures lead the charge higher, up 0.4%. Your Russell 2000 little change, with an S&P just under 6,000, up 1/3%, Manus.
And there's NVIDIA for you, up 1.84%. Let's talk about the long end of the curve, Danny, because 30-year bonds is where there has been a ransacking, one could say, but perhaps not full vigilantism. Let's give you the stats. JGBs on the long end, the highest since 2010. The UK, the highest since 1998. And here in the United States of America, the highest long end on the bond curve since 2023. Jack Janasiewicz is a portfolio manager over at Natixis, and he writes this: looking at the inflation, simply put, the labor market continues to cool. The housing market shows plenty of disinflation still in the pipelines. So who's wrong? These bond traders on inflation, or is there another side to this market? Jack joins us now. Jack, we just had Stephen Major with us, and he said this spike in the bond yields is not to do with inflation. It is to do with a resetting of the rate-cutting narrative. You say that we should be a little bit calmer about the inflation narrative. Why? What's going to substantiate your inflation view 2025? Good morning.
Good morning. Yeah, and thanks for having me on. And I think those comments are pretty much everything can work in tandem together there. But the bottom line for us, let's just take a step back and look at the big picture backdrop, right? For us to have an inflationary impulse, which would probably be the bigger negative here, especially for the equity market, I think you need to see a reacceleration in the labor market, and specifically on the labor front with wages. And all the ancillary data that we're paying attention to, we just don't see that right now. Everything is trending lower. And the second one, which is a fairly big line item in the core PCE or core PCI relative to the rest of the basket, it's that shelter component. And all the real-time data that we're paying attention to on the shelter component continues to trend lower. So take a step back. Those two big things are working in the right direction. We could get a few idiosyncratic blips along the way in here, which is what I think you might be seeing in the last inflation print. I'm not sure that's really enough to change the narrative in here and where I expect to see inflation reemerging.
Jack, it's an important point that the reason why bond yields go up are really the mechanism for why equities react. That if it's inflation, it's bad for equities. But at some point, at some level, does it not even matter? Because yesterday we saw strong economic data, we saw yields react off the back of that, and stocks sold off.
Yeah, and I think there is an imaginary line in the sand, so to speak. That 5% threshold on 10s probably does trigger some indigestion. But, I think the big takeaway here is simply that why are bond yields rising, right? If bond yields are rising because the growth prospects are looking better, that probably means something better for earnings per share expectations. That's going to be a net positive for the equity market. But if bond yields are rising because inflation expectations are moving higher, that's probably going to be a headwind for the equity market. So I think you also do need to distill why the bond yield is rising in here. And when we look at things like real yields and inflation break-evens, they're both drifting higher. For a while there, it was really more on the real yield front, which tells us a repricing of that growth expectation. But I think that's the key to pay attention in here into how that spills over into the equity markets.
And that's where you think that we're going to get some kind of, to paraphrase what other people are saying, an exuberant correction. You think there will be a growth scare? You think it'll come in the first half? What's the consequence of that for equities?
Yeah, and I think, given where we are from a valuation perspective, given that we've had 2 consecutive 20-plus years of equity market returns, when you look at the S&P 500, people, I think, are going to have somewhat of an itchy trigger figure in here. So it wouldn't be shocking if we sort of get some data in here that is enough to be a catalyst for them to say, hey, it's time for me to take some chips off the table. And that might actually produce that proper 10% correction, something that we haven't had in quite some time, quite frankly.
Jack, a lot of that uncertainty has prompted calls for gold, but I thought it was quite telling that Goldman Sachs just this week, who had been very bullish on gold, pulled back their forecasts and now expect gold prices to not hit $3,000 because of easing uncertainty. Does that uncertainty as to whether we get 2 cuts, 1 cut, or maybe none, reduce the attractiveness of gold in a portfolio right now?
That's a tricky one. I know there's always that cost of carry argument that people like to make with regard to gold and comparing that to the safe haven assets of, something like the treasury market in here. But if you are going to start to lump in a lot of the other uncertainties, things like, how are the deficit issues in the United States going to be addressed? What are we going to start to see from a supply perspective? Are we going to see it in coupon? Are we going to see it continued in the front end of the curve? Is inflation sticky? The list of uncertainties continues to go on and on. So I wouldn't be shocked if gold continues to still hold in here, especially as just simply a diversifying asset. I know we have a competing asset class now in cryptocurrency, so Bitcoin might steal a little bit of that thunder in here, but I certainly don't think it's time to completely abandon gold in here. And I think that there's still plenty of uncertainty still out there that warrant, that diversification within that portfolio.
Jack, one thematic of 2024 was the barbell approach from a number of people, particularly State Street, that wanted cash on the right-hand side and they wanted, or tech on the right-hand side and cash on the left-hand side. It was that barbell approach. I just wonder, as we go into 2025, do I supplant or enhance my tech on the right-hand side with top-ups like defense? You've got President-elect talking about defense spending at 5% now. Never mind your 2%, which a lot of people are struggling with. Now talking about 5%. So just talk me through your barbell and what that should look like for 2025.
I think you really can't give up on tech in here, right? Tech, I think, will continue to work, especially large cap tech, if rates remain elevated, right? I think the key for us is that 10-year yield needs to move back down closer to 4%, even maybe break through to really see that broadening out of that market breadth. And that breadth might be whether it's small and mid cap or even international. So we still think tech sort of acts as a defensive posture here, because if they're somewhat relatively immune when you look at those higher funding costs, those higher rates relative to the broader market. And I think you're still continuing to see massive growth in there, right? Earnings expectations for 2025, that growth rate, tech very, very strong. Margin expansion still pushing higher. So can't abandon tech. And at the same side, I would also look at things like cyclical value for the other side of that barbell, simply because, as we talked about earlier, yeah, we do expect a growth scare, but that growth is simply going to be a scare. And we think, investors tend to overshoot to the downside. That'll give you your 10% correction. But I think on the other side, the economy's still going to hold up fairly well because there's going to be a floor in there, whether it's the Trump put or the Powell put. I think growth is still going to settle into the long-term averages, that soft landing, and that's why you still want to own that cyclical value source side of the equation in here.
Jack, your tech CEO wearing a $900,000 watch very blatantly doesn't concern you at all?
Again, it just goes back to that growth backdrop, right? At the end of the day, that's the big one.
I love it.
If I
growth is better.
Maybe I start wearing the chain too. I don't know. Maybe
I want the chain. I want the chain.
Oh boy, Jack, you and Manis can match. You both can get the chain. That's it. Things are doing well and plenty, so you can wear the chain, you can wear the watch. Jack, thank you so much for joining us this morning. Jack Janasiewicz of Natixis there with your style inspiration for the morning. Okay, coming up, we're going to unpack the incoming President Trump's blockbuster presser at Mar-a-Lago. Maybe some gold chains and watches. That's all coming up next on your brief.
We're going to be changing the name of the Gulf of Mexico to the Gulf of America. We need Greenland for national security purposes. People really don't even know if Denmark has any legal right to it. But if they do, they should give it up.
Can you assure the world that as you try to get control of these areas, you are not going to use military or economic coercion?
You're talking about Panama and Greenland. No, I can't assure you. I think NATO should have 5%. Yeah, if you're going to have a country in a regular military, you're at 4%. I think they should be, they're in dangerous territory. I think it should be, they can all afford it, but they should be at 5%, not 2%.
President-elect Donald Trump at Mar-a-Lago and his foreign policy plans when he re-enters the White House in less than 2 weeks. Joining us now is Bloomberg's Enda Current in Washington, D.C. Enda, Trump is someone who had campaigned on a more isolationist policy, but what we got on that press conference are these revived threats of taking land from Denmark, Canada being absorbed into the U.S., changing the name of the Gulf of Mexico, and being really aggressive on Middle East foreign policy. How should we interpret it this time around?
Yeah, no question, Danny. Very sweeping, as you say, aggressive and unusual comments from the President-elect Trump about what he plans to do, not just territorial expansion, but also claims of or threats to levy heavy-duty tariffs on Denmark, a treaty ally, and of course the threat to presumably ramp up violence in the Middle East in one way or another. So covering a lot of ground, it is unusual, but I think a lot of economists and geopolitical analysts reacting to this make the point that yes, you don't quite know what's bluster and what's bluff, but ultimately you have to take what he's saying seriously. He does seem to have some designs on cutting, or at least pushing for some kind of negotiations with Greenland. He seems to be serious about criticism in terms of the influence of Russia and China on the Panama Canal, key trading route. And of course, we know full well he's talked a lot about tariffs and NATO spending when it comes to Europe for many, many years now. So yes, to be clear, it's unusual, it's confusing. We don't quite yet know how it's going to play out. But he's also consistently raising these issues as well. So we have to expect that something's going to happen during his administration.
Well, it's the kind of classic rhetoric, isn't it, that we became used to during the first Trump administration. One thing from John Hopkins, they talk about it as perhaps continentalism displacing globalism. Listen, there's also policy, and this weekend there's 20 GOP lawmakers heading to Florida to talk about tax. I think one of the lines is there's some salty people in this coalition. They want a reasonable adjustment. That was from one of the House members. They want a reasonable adjustment. What are they going to be lobbying for? What is a reasonable adjustment on salt that's going to get these 20 salty Republicans over the line? Nick LaLota, actually from Long Island, called them that.
Yeah, well, look, they are lobbying for this, for increasing this cap on salt. Manus, to your point, I think the fact that the meeting is taking place in the first instance is seen as a positive, that this idea is back on the runway. I think when you consider that the Republicans have a majority, slim as it is, in the House, they can't obviously afford to lose votes on this, but they have that majority. And that President Trump himself has come around to reversing his initial policy decision on this, suggests that all of this is heading in the one direction. But let's not forget that this really is only one part of the broader massive tax discussions that are underway and will be underway towards what President Trump is talking about pushing through in one huge bill later this year. That's personal tax cuts, that's corporate tax cuts, that includes other individual measures, that includes this SALT measure as well. So the fact that these talks are happening in the first place suggests that there is policy traction. We don't yet know the details, Manus, but it does suggest there will be some kind of an outcome on it.
Okay, and let's see what kind of deal they come up with. That's Enda Karen of Bloomberg News on the latest from Washington. There's a growing list of executives paying a visit to the incoming president at his residence in Florida. Let's take a listen to the NVIDIA CEO Jensen Huang speaking to Bloomberg at the technology conference at CES.
I'd be delighted to go see him.
Have you been invited?
Not yet, but I would be delighted to go see him and congratulate him and do everything we can to help this administration succeed.
It's a pilgrimage now for a lot of CEOs. Let's bring in Tom McKenzie. Tom, good to see you this morning. In terms of the CEOs, we've got a whole host of them traveling to Mar-a-Lago. This is about changing your board. This is about making your relationship with Donald Trump very, very clear. As we talk about CES this year, is that the dominant theme, is how to, as it were, Trump-proof your business or improve your rating opportunity from the technology world to the Trump world?
Well, you've seen that across a number of areas, haven't you? You've seen Jeff Bezos, of course, pulling that editorial that would have been in support of Kamala Harris. He's made a donation. Amazon's made a donation to the inaugural fund for Trump. You've seen the moves, pretty significant, of course, from Mark Zuckerberg, and we'll get the details on that in a minute, in terms of trying to appease the incoming President Trump. It's, to some extent, surprising that you have not had Jensen Huang at Mar-a-Lago already. It's surprising that he hasn't received that invite. That's what stood out to me from that comment, given the central role that NVIDIA plays within AI and, of course, the tech executives that Trump is surrounding himself with. Worth noting as well that Sam Altman, of course, within the AI world, has also made that $1 million donation to the inauguration fund. So this is a theme, you're right, in terms of what we're seeing from executives. They try to align their businesses to what they expect to be the policy agenda of incoming President Trump. A couple of other things that stood out in terms of Ed Ludlow's conversation with Jensen Huang was being pushed by Ed on what the commercial cases are for some of these futuristic policies or futuristic bets that Jensen is taking at NVIDIA on things like robotics, on things like autonomous vehicles, on things like their AI foundational model. And the inability to put a real dollar number on that seems to speak to the caution that we've seen, at least in the last 24 hours, when it comes to the NVIDIA stock, not being able to close that gap. But he was insistent that the demand for data centers is still very strong.
I thought you were going to say the most important thing, Tom, was that I was indeed right. Now that we got that close-up interview, that he was wearing an alligator skin leather jacket.
Tom Ford.
You're welcome, everybody. I mean, it's like the moment of everybody obsessing about fashion on tech executives. Everybody loved that story about Mark Zuckerberg's $900,000 watch. Manus, for me, I was like, rich guy buys an expensive watch, and we care why?
Well, they used to take a go at finance bros and their watches. You know, now it's tech bros. I want the chain. No. She can have the $900,000 watch.
That's a fair trade for me. I will absolutely take that.
Yeah, but we don't know what the chain. I don't think the chain's worth $900,000.
Probably that's why I'll take the watch over the chain. But I mean, Tom, just jokes aside, I mean, it is a new image of a Mark Zuckerberg. Oh, there's the watch. Okay, we're going to continue obsessing over it. Okay, so, I mean, it is a different Mark Zuckerberg, be it his image, be it the chain, be it the complete rethink of the company and how they do things like content moderation, which, by the way, let's be honest, things will still find their way to the internet, whether content is moderated or not by third parties. What does it say about this broader moment we're in?
I'm still stuck on that beautiful Swiss timepiece. They make one or two of these a year. We know that Manus gets one. We now know that Zuck gets the other. Look, yeah, this has been a pivotal change. It's not just the aesthetics for Mark Zuckerberg with the baggy T-shirts, the chain, and now that 900,000K watch. It's also the changes, of course, that will be central to Meta and to Facebook going forward, particularly in the US market. I mean, everything from putting Dana White onto the board, of course, that close Trump ally, to having that new policy chief in terms of the Republican background that individual has, to trying to reshape this company to align with Trump. The most significant, certainly symbolically, was what was announced yesterday, of course, in terms of, as you said, removing the external moderation. And by the way, more quietly as well, easing up on some of the policy constraints around the use of language that could some would argue, lead to more aggressive, maybe hurtful language on the platform going forward. That is something that's been flagged as a risk. But this is an executive that's trying to mold the company back towards something that is more aligned with this incoming Trump administration. And what a pivot it has been. He's been called the enemy of the people. Trump called Zuck the enemy of the people, and he's threatened to put him into prison not that long ago. The pivot has been significant. He's dined with him now in Mar-a-Lago. He's made the changes to the board, and now he's made this significant change around what he describes as censorship. Others would say simple fact-checking.
Yeah, well, he chose Fox and Friends to actually deliver that message and discuss it. And we know that that is, of course, a favourite of President-elect Tom. Thank you very much. And for anybody that wants to get one of those watches, just they don't know what the brand is, it's Rubel Forcé. And there's only 2 or 3 a year, handmade. One day, Tom, one day.
I love this idea that there's so many people out there clamoring for a $900,000 watch.
You just need to go on Rich Go on Bloomberg, and you actually.
Well, you think someone's going to be reselling that thing?
Well, I'm going to go on Rich Go now in a couple of minutes and have a little bit
Manis,
of
we already settled this. You're getting the chain. I'm getting the $900,000 watch. Okay, Manis, we're also keeping our eye on Albertsons this morning.
Market.
A different market, very different market. Albertsons will be reporting earnings before the bell. Let's go to Bloomberg's Dasha Afanasieva on this. Dasha, it's a different prospect for Albertsons. Last earnings, they were saying we're confident that this Kroger deal will be done, and maybe that helped to kind of assuage some of the investors and not that great of a set of earnings. What happens this time around when the deal has been denied?
Yeah, and I mean, looking at the share price, there was a pretty strong. The market certainly believed that the deal wouldn't go ahead. So the CEO Vivek Sankaran has had plenty of time to think of the alternative. And I think investors really want to see a plan for medium-term growth, which means a savvy digital strategy, the progress on its loyalty scheme, more than there has been already, and of course the standard putting shops in the right places, having low inventories. Meanwhile, the company is also suing Kroger over the deal, so it's quite difficult to sort of totally kind of draw a line under things. And appease shareholders who didn't get their massive payout, whilst also, moving forward with this lawsuit. And of course, it's tricky for both sides because they both have to argue to investors that now will be completely fine alone, having told competition regulators that they're actually going to be more of a strong power to challenge Walmart. But it's harder for Albertsons because it's smaller. And because it's sort of been caught on the back foot. And I think the CEO's been around for almost 6 years, and he's going to have a tough time convincing investors that it's plain sailing.
A tough defence strategy. Dasha, thank you very much. Dasha Afanasieva there on the very latest on Albertsons. We're going to set you up for your trading day, 30-year auction coming up. We'll give you the details in just a moment. Good morning from New York.
Let's get you set up for your trading day on this Wednesday. Jobs data on deck. ADP comes at 8:15 a.m. Eastern. Jobless claims comes one day earlier than usual at 8:30 a.m. Then 30-year Treasury bonds go on auction this afternoon. And finally, we're going to get the Fed minutes, Manis. Those come out at 2 p.m.
Yep, a lot to chew on, Danny. That is that $22 billion worth of 30-year paper. By the way, the long end of the yield curve, Stephen Major has been with us this morning. He said this ransacking at the long end of the curve is to do with real rates, Danny, and the drop in the expectation for Fed cuts, not the inflation narrative.
But perhaps it's different elsewhere, where the fiscal headroom is really thin. You're looking at UK bonds there, the highest since 1998 for the 30-year yield. For Japan, the highest since 2010. That's it for your brief. Surveillance will take things from here.